and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I'm going to give an update to my portfolio, and then I will discuss the latest purchase which I have done within the week, and then I will answer some questions which I have received from the audience. And it is not too surprising for me to see that I have received some questions regarding ETFs and index funds. What is the difference, and what is a UCITS fund? So if you want to know the answer to those questions, then stay tuned for more. Now, let's take a closer look at the portfolio. So the first thing we immediately notice is that there's a green circle for this week's episode, meaning that the portfolio is up in value compared to last week. If we then go and take a closer look at the portfolio value tab, you can see that the value has increased by $6,500 compared to last week, but at the same time the cost has also increased by $4,004. Meaning that I have had a gain of close to $2,500 within this week. If we then go back to the overview, then we can see that it is within the industrial that I have increased since last week. It accounted for a little less than 9%, and now it is above 12%. If we then scroll up, then we can see that it is General Dynamics that I have decided to invest $4,004 more into since last week. And I have actually decided to add an extra column in the overview arc here, so you can now see the dividend yield for each individual holding in the portfolio. So the way that I arrive at the dividend yield is simply taking my annual income, meaning column N, and then I divide by how much I have invested. So if we take AbbVie as an example here, you would say it is N3 divided by E3, meaning that I will get 6.13% in dividends each year for the amount that I have invested. And this addition to the arc is simply just to give you a better overview, so you for instance can see that my highest dividend yield is currently AT&T, which pays more than 7% in dividend. And if we're not factoring in the companies where there is no dividend currently, then you can see that my lowest dividend payer is currently Wells Fargo. That is not too surprising since they cut the dividend in 2020 with 80%. So let's take a look at the dividends with this investment. So I paid $4,004, which gave me 26 stocks. Currently there is a dividend of 1.1 every quarter for every stock that I have, meaning that I will receive $114 every year. After withholding tax, that is $97, which means that every quarter I'm receiving a little more than $24. And with my initial investment here, I paid $13 to do that investment. So the first time I will be receiving dividends, then I'm actually more than covering my costs of doing this purchase. So it will start to add to the snowball after I have received my first dividend. So that naturally leads to go and take a closer look at the dividends tab. And you can see here that I have not received a single dividend within this week. But what we can see over here is with my newest purchase, I am now expected to receive more than $3,000 in dividends within 2021. So I'm really happy to cross that mark already here in January in my expectations for the year. And you can also see that the average yield on the dividends is 2.8, so that is actually a little lower than the dividends which I'm going to receive from General Dynamics, but you have to remember that this is after withholding tax, so my newest purchase is actually a little lower on average yield compared to the entire portfolio. If we then turn to some more company specific related news, then I'm really happy to see the Tanger factory outlet reinstates their cash dividend. The company intends to satisfy the minimum taxable income distribution requirements to maintain its real estate investment trust status, or simply just REIT status. And I know that Tanger factory outlet centers is not the biggest position in my portfolio. I mean, I had invested $1,000 there last year, but it still gives me an additional $45 before withholding tax a year. So I'm happy to receive that as well. If we then continue, we can see that Realty Income Corp has declared a dividend which is in line with previous giving it a forward yield of 4.87%. And just to compare, in my portfolio, you can see that I'm getting more than 5.4%. So I'm actually getting more than 0.5% more than what they are declaring. That is because I bought the stock at a cheaper price than where it currently is. So that is not too big of a surprise, but this just shows you the power if you were able to buy the stock at an attractive price. So that is why it is also very important that you include this margin of safety, because perhaps you will get some bargain deals. If we then continue, you can see the same thing goes for Unum. They have also declared a dividend which is in line with previous of 4.52%. But since I really managed to pick up Unum at a low price, my dividend yield is actually more than 6% on this investment. So that is what I have tried to indicate as a rule of thumb with guideline number 3, saying that the dividend yield should be above the 4-year historical average, because that indicates that you're getting a better bargain than what you would have as an average over the last 4 years. So just to illustrate here with General Dynamics, which I bought within this week, you can see that the dividend forward yield is 2.87%, which is clearly above the 4-year historical average. And of course, I know when you take a look at this graph, if you have bought it back in March last year, you would have gotten a much better deal. But I mean, that goes for almost any stock that is out there. So this is just to illustrate the point once again. And if we continue, then there has been some quarterly results out from JP Morgan, and we can see that they are beating both their earnings per share on a GAAP basis and the revenue, and they had lower credit losses than expected. So that is very natural that the share was indicated up in pre-markets. If we then continue with Wells Fargo, we can see that they missed on revenue and that shareholders are not really happy about that. Hence the share is down pre-market, which is not too big of a surprise either. If we then continue to questions from the audience, then I have received 2 questions that goes like this. Hey LMG, thanks for sharing some information on ETFs in your last episode. What is the difference between an index fund and an ETF? What is this UCITS that some ETFs has in their name? So to address the first question, what is the difference between an index fund and an ETF? So first of all, we need to define what an index fund is. An index fund is a fund that tries to track an index. And an index could be something like the OMX C25. If you're a Dane like me, the OMX C25 is the biggest index that we have in the country, and it contains the 25 biggest companies in the country. But for instance, if you are from the United States, then you have the S&P 500, which consists of 500 different companies. And here you can find a list of all the companies which are on that list as well. So an index fund tries to track an index, and it should be stated in the name what index it is trying to track. So now that we have established what an index fund is, what is then the difference from an ETF? Well, an ETF can in principle mimic an index fund, but for instance, you could have an ETF that holds the S&P 500 excluding oil stocks and weapon industry, so you can tailor-make it so it fits exactly the criteria which you want to hold in your portfolio. So that is why it is crucially important that you read through this KIID document for an ETF, this key investor information documentation, so you can see exactly what is in the ETF that you are buying, unless of course you just want to buy an index fund which mimics an index. And your second question, what is the UCITS that some of the ETFs has in their name? So UCITS is short for Undertakings for the collective investment of Transferable Securities. This means that there is a European set of standard rules that the ETF has to follow in order to put this into their name. So that is why they typically put it into their name, because then you should in theory have more trust in the ETF, because they have to follow all this stricter regulation. So since I have now shown what UCITS stands for, let me just try and show true rules that they have to follow. There are a lot of rules, so this is just to illustrate, since a lot of this would become rather technical and wouldn't perhaps add to substantial value to you. But just to give you a peek of the iceberg here, then rule number 1, an ETF must be diversified so that no single holding is worth more than 20% of the fund's net asset value. This can be flexed to 35% under certain market conditions, but it is an important rule that caps your exposure to any single security. Number 2, assets of a UCITS ETF must be segregated from those of the ETF provider under the supervision of an independent custodian. This ring fencing ensures that the investor's assets cannot be seized to settle liabilities of the provider should it ever run into financial trouble. So in more layman terms, this means that the first one here is that there's a cap of how much exposure you can have to a single security within the fund. So for instance, if you had something that was trying to track the OMX C25, since Novo Nordisk is by far the biggest company in that, then it would be capped to say we cannot have more than 20% of the fund's assets in this particular ISIN or in this particular stock. Number 2 here is simply, if your fund provider has financial trouble, then your investment is kept on a separated account from what they have, so they cannot use your assets to pay off their bills. And just to illustrate how it looks for those of you who haven't seen this UCITS before, if we for instance take this example, iShares Core MSCI World UCITS ETF, you can clearly see here that they're using UCITS in their name, since now they're showing to the world that they are indeed fulfilling all these criteria in order to be allowed to do so. So if you made it all the way to the end here, now you have received another portfolio update. You now know the difference between an index fund and an ETF. You also know what a UCITS ETF is. So if you like content like this, then please consider leaving a like, leaving a comment, or remember to subscribe to the channel, and feel free to follow along the journey until I hit 1 million, since this was the first time that I hit $100,000 in value. So now we will simply just continue the journey, and please remember to ask questions, because I try to answer as much as I can every single week. So until I see you next Sunday, bye!